for paying down your law school debt, sponsored by DRB Bank. DRB is a leading bank, national marketplace lender, and the fastest lender in industry history to reach $1 billion in student loan refinancing. FDIC insured and established in 2006, DRB has helped thousands of professionals with graduate and undergraduate degrees across the country to refinance and consolidate federal and private student loans. Many of their clients are attorneys. I'm your moderator for today, Katrina Castillo. I'm an ABA young lawyer, and I work for Children's Legal Services at the Florida Department of Children and Families. Joining me on the program is Alex Maslix. Alex manages business development for DRB Student Loan. He has more than 5 years of experience working with young professionals to help them navigate their student loan repayment options and formulate their repayment strategies. Alex has collaborated with some of the nation's largest professional associations and employers to implement student loan repayment assistance programs for their members and employees. Before we start the program, I'd like to give you some housekeeping information. As a reminder, the audience has joined this webinar in a listen-only mode. You have the opportunity to submit text questions to today's faculty by typing your questions in the questions pane of the control panel. You may send in your questions at any time during the presentation. We will collect these and address as many of them as we can during the Q&A session at the end of today's webinar. So Alex, why don't you get us started?
Thank you so much, Katrina, and thanks to the ABA for allowing DRB to sponsor this event. As you said, my name is Alex Maslach, and I work for DRB Student Loan. So quick background, DRB is, as you said, one of the largest marketplace student loan refinancing operations in the country. And we specialize in working with graduate professionals to help some of the most creditworthy borrowers in the country obtain lower rates on their student loan debt. So today we are going to focus on some of the repayment options which are available specifically to attorneys, starting out with the federal options and then moving on to some legislative changes which are coming down the pipeline, and also things that we've seen in the past few months, which will bring us to the lawyer's proverbial fork in the road. You know, student loans are very unique in that they're one of the very few pieces of debt that has any type of opportunity for forgiveness, as you'll see when we cover the federal programs. You know, so with this debt, you're either trying to have it forgiven through one of those federal outlets, or you're looking to minimize the interest as much as possible and pay the debt back as economically as possible, which brings us to the new option for attorneys, which is what we student loan refinancing. You know, the same idea as refinancing a home mortgage. That opportunity is now available with your student loan. So I'm going to cover that and also look at some case studies for the average law school graduate, you know, based on your debt level, average interest rates. We'll talk a little bit about how much you stand to save by even taking 1 or 2% off of your rates. And the goal by the end of the session will be to develop an action plan of things that you should be keeping in mind as you matriculate here through repayment, you know, and on further through your career. As Katrina mentioned, we've enabled the chat box today, so to the extent that you had questions, feel free to type them in. Since we have quite a few people on the call, we're just going to save everything till the end and hopefully be able to address as many questions as possible at the end of the webinar. So first up is changes in debt level. This, I think, just serves to put into perspective where we currently are with the outstanding student debt in the country. So back in 2005, total outstanding debt burden for the entire United States was under $400 million. 5 years thereafter, by 2010, it had just about doubled to nearly $800 million. And as we sit here today in 2016, total outstanding educational debt in the economy is nearly $1.3 trillion. So it's increased 3.5 times over the last 11 years. You know, however, incomes have not necessarily tripled over the last 11 years. So in light of this growing debt burden, the government rolled out a number of federal income-driven repayment programs which allow borrowers who have, you know, a really burdensome debt amount to make payments based solely on your income and family size. So there's 3 different programs which are currently pertinent to borrowers. There's income-based repayment, there's pay-as-you-earn, and there's revised pay-as-you-earn, also known as repay. And like I said, all 3 of these ask the borrower to pay just solely based on your income and family size. So income-based IBR is asking for 15% of your discretionary income to go towards the loans. Pay-as-you-earn and repay are asking for only 10%. All 3 of these programs have forgiveness components built in and of themselves. So if you were to pay an IBR for 25 years, at the end of those 25 years, regardless of where you worked, you could work at a for-profit entity. If you had a remaining balance on your loans, it would get forgiven. The caveat with this forgiveness is it's taxable. So theoretically, if you had $100,000 forgiven at the end of 25 years, they would wipe it off of your debt balance sheet. However, you'd need to pay a tax penalty on it. So it doesn't necessarily negate its value totally, but it's absolutely consideration in determining your strategy. Both pay-as-you-earn and repay also have these forgiveness benefits. Pay-as-you-earn, it comes after 20 years of payments for all borrowers. However, repay says that undergraduate borrowers get forgiveness after 20 years, but if you held a graduate degree, those loans would only be forgiven after 25 years of payments. So in that sense, pay-as-you-earn is preferable to the new repay program, at least for lawyers. All 3 of the programs see 3 years of partial government subsidy on your subsidized loans. So that means whatever your monthly payment isn't covering in subsidized loan interest, the government will pick up on your behalf for the first 3 years. Now, keep in mind, this is sort of a waning benefit in that most graduate professionals don't have a ton of subsidized loans. Those are given out primarily during undergrad. But it could certainly be worth, depending on how much you took out in undergrad, $1,000 or $2,000 worth of savings, depending on what you're paying over those first 3 years. In addition to that, repay, this new program, has a benefit that says the government will pick up 50% of the unpaid interest on all loans as long as you're not covering all of the interest. So in other words, if the loan is in negative amortization, which means if your monthly payment based on your income is not covering all of the accrued interest, then they forgive half of the remainder. So let's say that you were accruing, I don't know, $800 a month in interest and your monthly payment was only $400 a month. That means that the remaining $400 a month, the government would forgive half of that interest. So you would only essentially be accruing an additional $200 of interest. So certainly a big benefit, especially for borrowers with a really high 6-figure debt level, but maybe a more modest $50,000 to $60,000 starting salary. And this repay program just became available to borrowers in December 2015. So I'd certainly urge folks who are in that position with a high debt burden but more modest salary to look further into repay. This could be a good option. The programs, pay-as-you-earn and IBR, do cap your payments at the 10-year standard amount. 10-year standard amount is what you need to pay each year for 10 years to pay off the debt in total. That's the most you'll ever pay in either of the first 2 programs. Repay removes that benefit. So again, there's some pros and cons of repay, and that's likely one of the cons. So if you thought that at some point, your income was going to go above your debt balance, let's say you owed $100,000 and you anticipated earning $150,000, repay might not be the best option because your payment would not be capped. All 3 of these programs do not capitalize interest if you're not paying it all off on a monthly basis. So in other words, you don't accrue interest on interest, which is certainly to your benefit. So all 3 of those programs are eligible or qualify, I should say, for folks who plan on pursuing public service loan forgiveness. This is a big one on public defender or government personnel's minds, basically says if you work for a nonprofit employment also qualifies, or government entity, and you work there for 10 years while making qualifying payments on your loans, at the end of those 10 years, if there was a balance, it would be forgiven, totally tax-free. There's no caveat with this public service loan forgiveness. So I think there's a lot of misconception out there on the loan forgiveness that you need to apply for it or you need to commit to working in, this type of facility or that. In fact, it's all about positioning your loans and your employment such that they're eligible for the forgiveness. So there's a number of boxes to check. Number one, you need to have all federal direct loans, and only federal loans are eligible for this. So if you had some federal loans that were older or they were, Perkins loans, what you'd want to do, and this would be the first step, would be to consolidate everything together into one big direct loan, thereby making all of your federal debt eligible for this forgiveness. Need to work full-time, like I said, at a 501c3 or government entity. They classify full-time to be 30 hours a week. If you did 30 hours a week in that type of position and then maybe worked outside of that at a for-profit entity, that's totally fine. You can still qualify. And then it's 120 monthly payments to forgiveness, so 12 payments a year for 10 years. They don't need to be consecutive. So if you, left the public sector for a year and then came back, you would just pick up right where you left off progress-wise. And then, like I said, need to be enrolled in one of those 3 income-driven plans to pursue this. So, immense potential for those working in a qualifying institution to see a very large portion of your debt forgiven as it currently stands. It is worth noting, and I say this and recommend you take it with a grain of salt, but there has been proposed legislation to Congress to limit the loan forgiveness to $57,500. That's the maximum borrowing allotment for undergrads. So the proposal says that those who owe more than that would need to keep paying for the duration of the 20 or 25 years before the remainder got forgiven. So remains to be seen, number one, if this will even pass, and number two, if it does pass, if it will affect existing borrowers or the next crop of students who've yet to receive their loans. So I would imagine you folks as attorneys will have stronger feelings and a better sense of a grandfathering provision likely than I will, but I would advise keep a very close eye on the legislative ongoings. Programs, as we've seen, can and will change, and you need to be prepared to be flexible with your repayment strategy accordingly. So I touched on most of this on the last slide, but everything needs to be voted on. So nothing is imminent. Likely won't see any clarity until after the upcoming presidential election, but like I said, prepared to be flexible. So one more federal program I'll touch on quickly because these are very much specific to your state and your law school, but there's programs called LRAPs, Loan Repayment Assistance Programs, to where depending on where you went to school, depending on where you're working, you may have the opportunity to see some type of forgiveness or payment subsidies. Without going into too much detail, the programs range in size and scope based on where they're coming from. So, could be anywhere from a couple $100s to tens of thousands of dollars. There's 24 statewide available from Bar Association and state governments. So my recommendation would be, a quick Google search, LRAP. If you just Google LRAP, you'll be able to pretty quickly find if your state or your school has any type of program that you can qualify for. So that brings us to, as I said, the attorney's fork in the road. So there's 2 avenues to approach this debt. Assuming that your goal, at least for the time being, isn't to find some liquidity, so you're not one of the folks who need to use income-based or pay-as-you-earn, to find a lower monthly payment, then your goal should be to either try and get the loan forgiven by the government or try and lower the overall cost of the debt to you. So the easiest way to lower the cost of the debt is to lower the interest rate. The less you accrue in interest, the less you're going to have to pay out of pocket to get this paid off. So refinancing is the outlet through which, for those who qualify, allows you to minimize your interest accrual immediately and most effectively. There are a number of considerations that come along with it, though. So anytime you're refinancing a federal loan, effectively changing it from a federal loan to a private loan. And in doing so, you give up any subsidy benefits, you give up the potential to pursue forgiveness, to use those income-driven type of programs. So people who do this are folks who I think are very comfortable financially. They have solid, oftentimes six-figure incomes. They have strong credit profiles, so not like a ton of outstanding credit card debt. And they're people who aren't concerned with making the monthly payment as much as they are retiring the debt quickly and effectively. Another consideration, once you have decided to pursue refinancing, is do you want to take a fixed rate loan or do you want to take a variable rate loan? We, along with most of the other lenders out there, offer both. So fixed rate loans are going to stay the same rate the whole life of the loan. It'll never change, and that's how most of your federal loans are as well. Fixed rate loans, in comparison to variable, tend to be a bit higher rate because they have no risk, right? So variable rates can adjust, and in the student loan marketplace, they adjust quarterly. Ours are based on LIBOR. So if the economic interest rate environment increases, then your variable rate loan will also increase. If rates go down, your variable rate loan will go down. For our loans, the 5, 7, and 10-year terms are capped at 9%. That's the highest they could ever go. For the 15 and 20-year term options, the loans are capped at 10%. That's the highest they could ever go. Determining which variable versus fixed is best for you, a lot is dependent on if you're planning on paying the loan back quickly or over a longer duration. The faster you're planning on paying it back, the less interest rate risk you incur. So oftentimes maybe a 5 or 7 year term, variable rate can be very attractive. When you start looking at 15 or 20-year terms, variable carries quite a bit more risk. So absolutely something to think about. My recommendation is typically, get your application in. We'll make you all of your rate offers based on your loans and financial information. And at that point, you can see definitively, this is the rate I could get on a fixed versus this on a variable, and you can make a more educated decision then. As I said, this is the easiest way to minimize interest accrual. Even if you were going from, say, a 7% weighted average rate with the government to even 5.5% with DRB or another lender, that 1.5% when you're talking about hundreds of thousands of dollars is really meaningful. So based on the borrowers we've seen and worked with, the average lawyer is saving $23,000 over the life of their loan. So by no means an inconsequential amount, and I think it's important to recognize that 1 or 2% is really meaningful when you owe that much. This also can reduce monthly payments. Think about it. If you were apples to apples going to pay the loan back over 10 years, your monthly payment is going to be $100 or $200 less with a 5% rate versus a 7% rate. So save money in the short term, save money in the long term. Very attractive, I think, for those who qualify. And I think, to be clear, I always get the question, what's the catch? How are you able to do this? The reason that we can give lower rates than maybe the federal government or some other private lenders is because we're only lending to the best borrowers in the marketplace. And we believe attorneys are some of the best borrowers in the marketplace, right? So you have oftentimes very lucrative incomes. You're very financially savvy, responsible, certainly, and because of that, we think you deserve lower interest rates. So by only giving these loans to the most prime borrowers, we don't have to deal with defaults like the government or other lenders. So because everyone is paying these loans back, we can still be a profitable enterprise and afford to charge lower rates. That's the idea here. And I think it's worth noting for those who were planning on pursuing forgiveness with their federal loans, you can absolutely do that and just refinance your private loans with us. And I'll show a case study on that in a bit. So there's a look at our term and rate offerings. You can see we have terms 5, 7, 10, 15, and 20 years, both fixed and variable rates. And in each one of those terms, there's a range of rates. So what determines where you fall within that range is your credit, your total debts, and your total income. So the more that you earn relative to how much you owe, the better your rate's going to be. The higher your credit score, the better your rate's going to be. That's really what we're looking at to determine where within each one of those ranges you fall. So when you apply, and I'll give you more instructions on the application process towards the end, but we'll go through all of that. We'll make you rate offers for all the terms that you qualify for, and then you can decide which one you wanted to move forward with. And in addition to the low rates, we're actually giving all of those in attendance today an additional $200 bonus on your loan when you refi with DRB. There'll be a unique application link at the end of the presentation, which I'll share with you. So if you apply through that link within 45 days of the loan closing, we'll actually just cut you a check for $200. So this, I think, is a really telling case study and an eye-opener for a lot of people. So, in this scenario, we're assuming that an attorney graduates from school with $140K in loans. They get a good job out of school. They're saying, I'm able to pay this back over the course of 10 years. Current weighted average interest rate on all of their loans is 7%. This is the blue column borrower. So at 7%, their monthly payment is about $1,600 for an annual cost of just shy of $20,000 a year. So over the course of 10 years, they pay that, and their total out-of-pocket cost is just shy of $200,000, $195,000. Conversely, from the outset, that borrower decided to look into loan refinancing with us. And we said, based on your strong job, based on your strong credit history, we can offer you a rate of 4.75%. Fixed rate to fixed rate, so there's no additional risk there. Same 10-year repayment term. Instantly, because the rate is lower, their monthly payment is also lower, so about $1,470 a month for an annual cost of $17,600. So those might not seem like a ton of money, but if you look over the course of the 10 years, this borrower saves nearly $20,000 by locking in the lower interest rate. And then the gold column is the same idea. It's a borrower who believed that variable rates were going to remain low. And for the purpose of this example, we didn't try and predict what rates were going to do over the next 10 years. Everybody has a different opinion on that. So we just assumed that, the average rate over the 10 years wound up being about 3.25. So with that being the case, their monthly payment was quite a bit lower, about $1,370 a month, annual cost $16,000 and about $400 for a total out-of-pocket savings of just over $30,000. So again, variable rate has a risk component, but if you believed that rates were going to remain stable or even go down a little bit, variable rates can be a really good bet with a high potential for savings. So one more case study. This is, as I mentioned, a borrower who they were planning on doing forgiveness with their federal loans, or maybe they just only owed this one private loan. It's for $45,000. It's on a 15-year repayment term. The rate they got while they were in school was 9.5% from another private lender. You'd say, why is that rate so high? Well, when this borrower was taking the loan out, think about it. They didn't have a job. There was no guarantee that they would finish law school, that they would pass the bar, that they would, get a six-figure salary. So to compensate for all of those risks, the lender had to charge them a higher rate. So they gave them a 9.5% rate, and the total out-of-pocket spend to retire that piece of debt was about $85,000. Quite a bit, when you think it started out as just a $45,000 loan. So again, this borrower comes to DRB, we say we'll give you 5% based on all those factors which I've talked about, that instantly lowers their monthly payment to lowers it $113 and decreases their out-of-pocket cost over the 15 years by about $20,000. So this is, I think, probably a very generous example. 9.5% is about the very highest rate that we'll see on student loan debt. But if you were one of those people with the really high rates, the savings potential is immense. So, even if you didn't owe that much, oftentimes people will say, well, I only owe 30 grand or 40 grand. I'm just going to pay it all off. It's not worth going through the trouble of doing this. It absolutely is if your rates were that high. I mean, you can see in this example, $20,000 is quite a bit of money to save by just going through the paperwork of having us examine your financials. So who should consider this? I would say there's a number of buckets of people who should at least look into it. And it's worth noting you don't commit to refinancing just by applying. By applying, you just give yourself the opportunity to see what rates you could qualify for. You don't have to make a decision until then. So I would say if you're not pursuing loan forgiveness and you don't need IBR or pay-as-you-earn or repay for the liquidity flexibility, you should absolutely look into refinancing. If you're paying on any kind of a standard repayment plan, call it 10, 20, 25 years, and you don't need to lower your monthly payment, then looking into securing a lower rate, which can in fact also lower your monthly payment, would do you well. So again, no commitment to accept just by applying. If you had private loans, I'm very confident that the rates which we would offer you now that you've secured a job are going to be more attractive than what a lender would have offered you while you were in school. So again, likely worth looking into seeing what you can qualify for. And then, if you were working for a private enterprise, there's a good likelihood that forgiveness isn't going to suit your debt and income profiles, right? Folks who work at private enterprise tend to make a bit more money, and thus, if you were trying to get your loans forgiven in 20 or 25 years, unless you really owed, call it 250 plus, the likelihood is that you're going to have that debt paid off before you get to any forgiveness point. Taxes aside, it's tough to pay for a full 20 or 25 years and still have a balance remaining if you're working for a private enterprise. So again, refinancing is at least worth a look. And if you owed less than 80 grand on your federal loans, even if you were working for a nonprofit entity, the likelihood is that since you don't owe that much, you'll have it all paid off before you get to the 10-year point. So again, worth looking into refi. And these aren't all of the profiles of folks who should do this. I would certainly recommend, I'm going to share the bank's contact information at the end of the session here, but feel free to give us a call. We're not looking to, force people into doing this refi. We're very comfortable with telling folks that the federal programs sound like a better fit for you. So if you wanted to discuss your individual situation before even applying, feel free to get in touch with us. So here are some of the benefits specifically of working with DRB. I mentioned this before. It's totally free to apply. There's no obligation to accept. In fact, this entire process is free. There's no origination fees. There's no prepayment penalties. There's no disbursement fees. This is totally free. It's essentially just moving your loans from one lender at a higher rate to another lender who's willing to give you a lower interest rate. Both federal and private loans are eligible. So with all those federal programs I talked about, it's only the federal loans which qualify. We can work with both types of loans and from both undergraduate and law school. As you saw a couple slides back, we have a litany of repayment terms available, fixed and variable rates. You can even do a hybrid loan if you wanted, so you could put some of your debt on a fixed rate, some of it on a variable rate, and then maybe you pay the variable rate back more aggressively if rates started to go up. Worth noting, our loans are fully dischargeable in the event of death or documented permanent disability. So if you were to pass away or to become permanently disabled, we would forgive these loans, just like the government. We are also one of the few lenders to offer unemployment protection. So if you lost your job, or even if it was another circumstance where you had to take a leave of absence, you can forbear. In other words, you can agree with us to not make any payments for up to 1 year. And that's given out in 3-month allotments. So I think, oftentimes a knock on private loans is that they're not as flexible, and, to some extent that's absolutely true. We don't have income-driven options, but when unforeseen life events come up, we're very much willing to work with you as the borrower. I'll just add there that we have never had a single borrower default on one of our loans, and we've lent $1.4 billion. So I think that speaks to the fact that we're flexible and we have every incentive in the world to work with you. So action plan. What should you be keeping in mind? Well, if you think those federal programs are to your benefit, then a couple of things. Number one, you want to file taxes, as you'll want to use your tax return to verify your income for them. If you had non-direct loans, you would want to process a consolidation with the government. It's called a federal direct consolidation. That would effectively lump all of your loans into one big loan with the government. Doesn't change the rate, but it does ensure that you're eligible for the forgiveness. And then figure out which of those 3 income-driven programs suited you, and continue to monitor changes in public service loan forgiveness if you were planning on pursuing that. And lastly on there, like I said, if you had private loans and you were using, those federal programs for the federal debt, look into your options with us and other lenders. You may be able to continue pursuing forgiveness, but also lower the rates on your private loans as well. If refinancing you thought was something worth looking into, first step would be to engage with DRB. So I guess to give you a sense of how this whole process works, on the next slide I'm going to share with you a unique application link. So you would type that link into your browser, you would click Apply Now on our site, and then you're going to be prompted with a series of about 20 minutes worth of financial and loan questions. So you give us all that info, we'll do a credit check. So we'll see, have you ever defaulted on a piece of debt? Have you been delinquent? Have you filed for bankruptcy? Have you been a responsible borrower? And as long as you have, we'll say, great, you're pre-approved. Now we need all of these documents from you to verify everything that you'd entered. So, it differs from person to person depending on your employment, but things like pay stubs, driver's license, proof of graduation, loan payoff statements. You'll provide us with all of those. We'll do the underwriting in the coming days, and we'll get back to you with rate offers at all the terms that you qualified for. So at that point, you can determine which term makes the most sense, fixed versus variable. Let us know what you wanted to move forward with, and we would then initiate the process of paying off your existing loans and issuing you the new one at the lower rates. And at that point, evaluate the merits of paying extra. Again, there's no prepayment penalty, so you can certainly pay more. And continue to monitor the marketplace. So let's say a year from now, rates have gone down, or maybe you thought you were a better borrowing candidate because you were making more money. You could come back to us and say, hey, do I qualify for a lower rate based on this or that? And we'll reevaluate your candidacy, and if you did qualify for a lower rate, we would allow you to essentially refi again with no cost. So it's a fluid marketplace for sure, so continue to monitor it. And as I mentioned, that is the unique application link. So student.drbank.com/ABA webinar. If you apply directly through this link, we will give you a $200 bonus within 45 days of your loan closing. And if you want to discuss the refinancing process or discuss your candidacy specifically with one of our customer service professionals, feel free to email us at educationfinance@drbank.com or call us directly at 855-245-0989. And that was actually all I had for you today. I hope everybody found the information to be useful. I think it's a very convoluted marketplace with a ton of different options and no correct one for everyone. So, I think if I had one takeaway today, it would be to understand that there's opportunities out there, be it through forgiveness, be it through refinancing, to save yourself tens of thousands of dollars on this debt. So I think Katrina and I are going to try and work through some of the questions which it looks like have come in now, and hope to get those answered. But other than that, hopefully we'll be hearing from a lot of you folks soon. Thank you.
Thank you so much, Alex, for all that great information. So I still see that you guys are sending a bunch of questions in, but to get us started, Alex, some of the major questions that we were getting, the first one I'll ask you is, when should someone refinance or consider refinancing? I know that there are some students who say that they're, a 3L who has a signed job offer from somebody to start in the fall after they've passed the bar exam, or should they apply to refinance now with that letter, or should they wait and have more of a pay history before they refinance before they apply to refinance?
That's a great question. I think one thing that's important to recognize is that there's no deadline to do this by. Assuming rates don't skyrocket, this opportunity is going to continue to be available. That said, the first time that you become eligible for it is once you've signed a job offer. So once you've signed a job offer, you can apply with us, and we don't need a history of income. We underwrite on future cash flows, so it's not like you'll get a higher rate because you haven't seen the paychecks yet. So my recommendation would be, if you were in that position and you were due to start working in September, but you've already signed the contract, apply now, see what rates we offer you. If you thought it was attractive, or if you thought it was lower than what you currently had, you can accept it. We'll still honor your grace period, so federal loans allow you to not pay for 6 months after graduation, and we'll allow you to do the same thing. And then if you thought you were more creditworthy or rates had gone down, when you did start working, you can again have us reevaluate and see if at that point you could secure a lower rate. So no cost to doing that. Any more questions, Katrina?
Sorry. Students some of our attendees are asking, for those who are, if they want to change between income-based programs, do they lose the time that they've already paid on those, on that previous program if they're going to change to another one?
So if you're talking about the progress towards public service loan forgiveness, no, you do not lose that progress. So if you've been in IBR for 3 years and now Repay becomes available to you and you want to switch to that and you're planning on doing public service, then no, the clock doesn't reset. But the long-term forgiveness, 20 or 25 years, that one does reset by switching programs.
And how does refinancing affect your credit score?
Yep, that's a very common question. It actually has no impact on your credit score other than the fact that we have to pull your credit to evaluate your application. So that's a very minor blip on the radar, and honestly shouldn't have much of an impact, provided you don't have a number of hard inquiries in a short period of time. But other than that, just moving the loans from the government or a private lender over to us has no impact whatsoever on your credit score.
If so, you talked about the fact that you guys also do forbearance for your lenders, and does that deferment time extend the life of the loan, or do you include that in the life of the loan?
So that would extend the life of the loan.
And there has some other questions about when they should refinance. If someone looking to buy a house over the summer, they're asking, would it be better to refinance before they buy the house or after they've gone to the mortgage lender?
Well, I think there's two sides to that coin. Again, since this doesn't have a negative impact on your credit, doing this before purchasing a home should have no adverse effect. In fact, it may very well help you qualify for a mortgage or a lower rate, because when the mortgage lender goes to look at your financial picture and they see that you have student loans, but they're at a lower interest rate, let's say we're giving you 5% versus the 7% you had before, apples to apples, you're going to have more free cash flow because you have a lower rate after refinancing than you would have with the higher rate. Now, that being said, doing them both at the same time probably wouldn't be in your best interest. I know mortgage lenders are very finicky about credit pulls during the mortgage process, so you would probably want to complete one and then start on the next one, in whatever order made the most sense for you.
Would you suggest that borrowers pay their subsidized loans first or on their higher interest loans first?
Always on the higher interest loans first. If you were looking at all of your debts across the board, from credit card debt to student loans to if you had a personal loan, auto loan, you would just want to work your way down the ladder, paying off the highest rates first and then moving on to the next highest.
If someone's already refinanced their loans, can they still use this option to refinance with you?
Absolutely. So you can refinance as many times as you want. There's no real downside to doing so, assuming you can continue to get a lower rate each time you refi. Because remember, there's no cost at all to do this. So you can move from another refinancing operation over to us at no downside to you.
And we've had some questions about what do they consider when we were looking at the income-based repayment options, that what's included in your discretionary income?
Yeah, so it's your adjusted gross income, and this is assuming you use your taxes to verify. So they're looking at your adjusted gross, subtract 150% of the poverty line for your family size. So the bigger your family, the more they're going to subtract, and then they multiply that amount by either 10 or 15%, depending on which of the three programs you're using. That's what you're going to pay over the course of the year, and divide it by 12, and that's the monthly payment.
Can you go from a variable to a fixed rate loan with DRB, or vice versa, from a fixed to a variable rate loan?
You definitely can. It's essentially like processing another refi, right? So let's say you took out a variable initially and rates started to go up, so you wanted to switch into a fixed rate loan. You could do that, but keep in mind the fixed rate which we offered you at that point might not be as low as the fixed rate which we initially offered you because rates have gone up. So yes, you can do it, but you're susceptible to higher rates if that was the reason you were changing.
So would any of your advice change to those who are beginning a fixed term employment, like a 1 or 2 year clerkship or fellowship? Would any of your advice change for those individuals?
I would say those are the people who are in a position where you should be using income-based repayment, pay-as-you-earn, repay for number one, it's liquidity. It's going to dictate based on, in most cases, a more modest salary during those type of positions, a more manageable monthly payment, and it'll also keep the door open to pursuing loan forgiveness, because most of those type of roles oftentimes are with the government, with a district attorney's office, places where you might have the opportunity to pursue forgiveness. So I would say if you were if that was your position, stick with the federal programs for the time being, and then once you know where you're working after that, you can make a more definitive decision on if refi is right for you.
Thanks so much, Alex. And does DRB have, what are the closing costs on your guys' loans if you have any?
We have none. So I think that's a misconception for, especially for people who've refied a mortgage, and that's always a consideration. This is totally free. So there's no application, there's no origination fees. We pay off exactly how much you owe right now, and you will owe us that exact same amount, just at a lower rate.
For those who are looking to refinance, if they're married, is there any recommendation you would make about whether to file their taxes jointly or separately?
So your tax filing for purposes of refinancing has no impact. If you're married and you're thinking about refinancing, the consideration would be, do you want to apply with your spouse as the cosigner, or do you want to apply as an individual? Let's say you were someone who was right on the border of being approved. You can certainly add your spouse as the cosigner, and that might help get you over the finish line to be approved. So maybe for folks who had a higher debt level versus a lower relative income, and they had a really high earning spouse, then that's a great option to add your spouse on as the cosigner. It's also worth noting, if you had a spouse as a cosigner and you were to pass away or you were to become permanently disabled, the loan would still be discharged. It wouldn't fall as an obligation on your spouse.
That's great. Thank you so much, Alex. If a student's refinancing their loans with you, are they still able to deduct how much interest they're paying on their student loan?
They can. So this with us is still absolutely considered an educational piece of debt. So you can, to the extent that you are eligible to claim an interest deduction on your taxes, you can still claim that on this loan. Keep in mind, as you start to earn more money, I'm not positive of the exact number, but it's around $80,000 annually. If you're earning more than that, then the income deduction starts to dissipate.
And I know that we've talked about those in the government sector and those in the private sector, but what about those people who are self-employed? How might some of this affect those who are self-employed?
Yeah, so those are folks who wouldn't qualify for like a public service loan forgiveness, but could still absolutely qualify for refinancing. It's a slightly more cumbersome application process because it's not as straightforward, like you can just show us your W-2. We typically, for folks who are self-employed, are looking for some type of form of a business tax return, so we can see what type of income has your business been generating, and then we'll underwrite based on that.
Thank you so much, Alex.
Sure.
And what about those who, if they've already had loans that are consolidated, can they only refinance part of an outstanding balance?
You can refinance some or all of any of your loans. So a lot of times what people will do, maybe they have some loans that were at a lower interest rate for whatever reason. They'll leave those out of the refi application with us, and they'll only refinance the higher rate loans. That's absolutely doable.
And you stated that that you can refinance at any point during the life of your loan, correct? As many times as you need?
Exactly. As soon as you've obtained full-time employment, you can refinance your loans at any point.
And there have been some questions about what's the difference between consolidation and refinance?
It's a good question, and I think a lot of misnomers surrounding it. Consolidation refers to the idea that you're combining a number of loans into one loan. So if you're working with the government and you wanted to do a direct loan consolidation, that's what's happening, is you're effectively just lumping all of your federal loans into one big loan, but it doesn't change the interest rate. In fact, when you do a direct consolidation, they round your interest rate up to the nearest eighth of a percentage point. So that effectively increases your interest rate, whereas a refinance, it lowers your rate. So when people come to us, most times they have different loans. So, whether it's 2 or 3 or 10, the effective result is oftentimes, yes, the loans are consolidated into one, but more importantly, from a numbers standpoint, they're lowering their interest rate. So refi refers to lowering a rate. Consolidation refers to combining.
Thanks, Alex. Would you recommend paying off credit card debt before refinancing?
It depends. It certainly has an impact on your credit score. So if you had a ton of outstanding credit card debt and you weren't paying it off every month, it oftentimes can bring down your score. So in that regard, it might help you get a lower rate with us, having paid it down. Another thing worth noting is we do actually have a personal loan program. So if you were one of those people who weren't paying off your credit card every month, and let's say you were carrying a $10,000 balance at 18%, maybe you can both refinance your loans with us and effectively pay off your credit card debt by getting a personal loan from us. So you take a personal loan at 6.5% or 7%, and you use that money to pay off your credit card debt to accomplish a number of initiatives in one fell swoop.
Awesome. Does DRB have an aggregate limit for the total amount of student debt that they'll take?
We don't. That's a frequent question. Everybody always thinks that they owe the most of anyone they know. I can almost guarantee there's no attorney on this call with more debt than we've seen. So there's no limit. There is a $5,000 minimum, though.
And what would you, any suggestions for those who make those six-figure incomes that you were talking about? Any special suggestions for them?
I think the folks who earn low six figures are some of the best candidates for refinancing. You talk about a low six-figure income right out of school, that's certainly putting you in the top quarter or so of the profile of your graduating class income-wise. And with attorneys' debt levels, relatively speaking, compared to like a physician or a dentist being a bit lower, the folks with low six-figure incomes, I think are good candidates for the refi.
Now, going to the opposite end of that, is there any special suggestions that you would give to the students who are on the call today, not those who are yet in the practice, but those who are still in school?
I think it's important to look at this debt in a long-term perspective, try and minimize what you're taking out to the extent that it's possible. Obviously, you need money to live, but in most cases, assuming that you're not all in on pursuing loan forgiveness, it's important to recognize that you are going to have to pay this back at some point. I think taking federal loans during school is probably the best bet because it leaves all doors open. You can still pursue forgiveness, you can still use income-based repayment, you can still refinance if you wound up taking a corporate job. So I would say minimize what you borrow as much as you can, and stick with the federal loans as much as you can.
What happens with the payments if you refinance and then in a year you decide to go back to school?
We would put the loan into deferment in that circumstance.
And somebody has a question, does overpayment on your loans count towards your next payment?
Overpayment, no, it doesn't forward pay the loan. It just pays down the balance, assuming there's no outstanding interest. It would just result in the loan being paid off earlier.
And can you tell us again what loans are eligible for refinance?
Any piece of educational debt, be it a federal loan, a private loan, an institutional loan, from undergrad, from law school, all would be eligible for this.
Okay, so we talked about those who make six figures and those in students. What advice would you have for somebody who's in the private sector and maybe moving to the government sector? So obviously they're more than likely going to have a a significant change in pay. Is there anything that you would tell them?
I would stick with the federal loans in that case. Given the uncertainty, anytime there's uncertainty in your employment or financial picture, like I said, the federal loans are going to be a bit more flexible. It's also, especially if you were looking to move into the public sector type of employment, you would preserve the ability to still get the loans forgiven in that case. So I would stay as is for those folks.
If somebody has more than one private student loan, should they consolidate those private loans first before they refinance, or should they just go ahead and see if they can just refinance all of those loans?
I guess it depends on the circumstance, but if you were someone who wanted to keep the federal as is for whatever reason, I would, yes, refi private loan right now. Number one, because you can always include it into a refi down the road if you got offered a lower rate, but number two, if rates went up between now and when you figured out what you were doing with your federal debt, you'll have secured the lowest possible rate on the private piece, at least for the time being.
When we're talking about income-based repayment plans if you have a private and federal loan, do they take your other loan balances into account when they're determining that discretionary income?
They don't. So those are the people who can be left in a tight spot from the federal programs, as if you had both federal and private loans. They don't consider the private piece in calculating your payment.
Do you guys have any special services or options for those who will be serving in the military?
We don't have like a special repayment program. I would think if someone went on active duty deployment, that we would very happily put the loan into deferment during that period. But there's no, it's not like the government where there's the potential to get the loan forgiven or to get a stipend because of your military service. In some cases, you can get money from your service, and you can put it towards your DRB loan.
Do you guys have any options? Are there any options for those who have had previous bankruptcies or other defaults?
So not through us. That is one of our, call it hard and fast underwriting rules, is that we can't do a loan for a borrower who's charged off a piece of debt or gone bankrupt in the past, as long as that continues to be on your credit report. So some of those things will come off after 4 or 5 years, and once that becomes the case, we'd be happy to evaluate your candidacy. But in the meantime, best bet would likely be staying with the federal programs.
And would you recommend any time frame between, like if somebody wants to refinance, and then how would you say that there's any like set amount of time after that they should look at refinancing that refinance, if that makes sense?
So just to make sure I'm understanding correctly, is there any timeline of when you should look into?
Yeah, like would you say every 6 months, every 2 years you should look at the, like if they refinanced with you today, is there any set schedule that you would tell people, after 2 years, look and see if you should refinance again based on their new income or new circumstances, or you should just wait for those circumstances?
Given how fluid the market is with rates changing, I think annually is a pretty reasonable time frame to reevaluate. Let's say you paid down a big chunk of the debt, maybe that helps you get a lower rate. So yeah, I think once a year is probably appropriate.
All right, I think we have time for one last question.
Okay.
Let me find a good one here for you, Alex.
Okay.
Well, actually, Alex, it looks like you've answered the majority of our group questions here. Most of these other ones are specific to specific individuals. So thank you everybody so much for joining us today. Again, Alex, thank you so much for sharing your time and expertise with us, and also for DRB Bank for sponsoring this with us. And once again, my name is Katrina Castillo. On behalf of the ABA, I'd like to thank all of you for joining us today. Finally, before leaving, there's going to be an evaluation to come up on your screen, so if you take a minute and fill that out for us.